Hello and welcome to a brand new show of Market Makers. Luckily for us, August and September have been quite heartwarming. We've come on the right side of global cues, and markets are convinced that central bankers have got the back of the markets. But surprisingly, volatility has come down at a time when we are pitted against important events like the outcome of US presidential election and voting in Italy. So let's connect dots here. We are on the brink of an earnings season, and this time around expectations surely are running high. So to talk about macro, micro valuations, I have with me the perfect guest, Neelkanth Mishra of Suisse. Thank you for joining us, and
pleasure to be here.
Always a pleasure to have you back. I'm a bit surprised with the global setup. We are staring at big market moving events, outcome of US presidential election, voting in Italy, and volatility in the market is just missing.
So I think what has happened is, one, that China seems to have stabilized. I think this is the first time in several years that we've seen China growth forecast getting nudged up. We have seen commodity prices actually starting to strengthen a bit. We have seen economic concerns that were emerging in Europe after Brexit, so they've been surprisingly resilient. And so far, the macro indicators, there is very little to have disappointed people. But we are headed into a period of turmoil. It's not just the elections that you mentioned, but I also think that sooner than later, if the economy, global economy does continue to show some signs of strength, then you will see the Fed wanting to raise rates. You will see the ECB getting into a tapering of their QE. We've already seen the BOJ being forced to change their approach because they're running out of bonds to buy, apparently. So there is a lot that is going to change from the monetary policy perspective globally, and therefore I think the coming months you may actually see some increase in choppiness.
There is a bit of a geopolitical issue in India. Is that something which global investors are taking notice of? Are you getting some, do you have to field some tough questions now? Not really.
No. So there was market churn that day, when the attacks happened, and we also held a call with experts, and clearly these are things that are out of the realm of our understanding. We don't understand in that depth. We all have views, but I don't think we understand them that well. And the experts that we had very convincingly said that this actually could be a stabilizing force and not a destabilizing force. And if you go back and look at, even if there was a kind of escalation, mostly it stays at the borders, right? And if you look at it very coldly and objectively, you will see that if you have a business or a listed stock which has operations along the border, maybe they get disrupted, right? Or if this escalation lasts very long, then there could be a fiscal impact. So basically the government's very nice fiscal consolidation path could get disrupted for maybe 6 months or 12 months. And so those are the only two ways in which financially this can impact. But both of those, at least the experts we had on the call very convincingly said that, look, it doesn't look likely. And if you see some of the recent updates that we are seeing on some Pakistani newspapers, it does seem that perhaps it's causing more introspection there than it is causing here. In terms of why is it that the Security Council refused to acknowledge or even consider this a conflict? The fact that there's been no international condemnation of what India has done, and that there are smart army, very smart politicians, I'm sure. So I don't think there is something really which is.
There's no nervousness in the market because of this event. Okay, now forget about nervousness. There is a lot of excitement in the market, and the large part of the excitement is related to good monsoon, better festival demand, and the fact that pay commission and OROP benefits would kick in. How realistic are the market assumptions?
Look, the economy has been very slow, right? In the last 4 or 5 months, the last time I was here, I did mention that as well, that the growth momentum, which was running along very well till maybe March, April, from May, June onwards, has started to slow. While some indicators like car sales and two-wheeler sales and tractor sales have shown some pockets of strength, by and large, it doesn't seem very far-reaching and very widespread. So oil demand has been a bit patchy. We had a good month, but before that we had a bad month. We had poor power demand growth. Credit growth is like at multi-decade lows and all of that. So there is, it is not a very robust economy. There are some segments where, because there have been decent rains after 2 years of bad monsoons, there is hope that people will buy two-wheelers and tractors, and therefore channel stuffing has happened. In a week or so, we will get to see how the Navratri sales have been, right? Will the economy revive robustly? I hope that by December, January, I think some of the measures. See, this year, the state governments are also doing a lot of capex. A number of them have actually expanded their fiscal deficit targets, and they are investing in capex. There's a lot of money that the central government is spending, a lot more than last year, and some of those only take off after October, November. And my sense is that by December onwards, and maybe the December data comes in January, we should start to see some pickup in momentum. On the GST side, while I'm very happy and positive it got passed, and I think it's a great development for India from a medium term, we have to be very cautious about the period of implementation. Because I would say that, I've heard some people say it, and I think it's hard to deny that, it would be among the biggest transitions ever undertaken by humanity, right? So a country as large and diverse as ours is going to transition from a relatively complex tax system to what is supposed to be a very simple tax system. And tens of millions of people have to understand it, have to adjust to it, and that cannot be a simple process. And that process can sometimes in pockets cause the economy to freeze because people don't understand what's going to happen.
So delay in GST implementation is good news, but actual implementation happens, then there could be a chaos.
See, the point is that yes, the delay of GST implementation cannot go beyond 16 September 2017, which is what I'm starting to call the GST cliff. Because as per the constitutional amendment, within 1 year of notification of the clauses, and the clauses were notified on 16 September, the rights of the centre and the state government to levy excise duty, sales tax, and all the taxes getting service tax, all the taxes getting subsumed under GST, those rights will go away. So it will be illegal for a state government to charge sales tax after 16 September 2017. And therefore that becomes a hard deadline. I mean, you can't delay it beyond that. I think that, therefore, so there's no option. I mean, it has to be done before that. Now, I think the 1st April deadline, and I've written about it as well, seems like a very hard deadline. See, hard deadlines help, given that everyone has been assuming that this will get pushed out again. It is very important for the government to give a message, boss, it's happening, start preparing for it. But if they really start 1st April, I think the level of preparedness that I see among software companies, ERP vendors, corporates, large corporates, forget about the small companies who may not even know about it, but the large corporates, and even the government reorg, so the whole of the indirect tax department and the centre and the state is going to change. Yeah. Right? And how exactly this is going to work, the GST Council has been debating the last 2 sessions, but they've also not agreed to how it's going to work. So you can see that everyone is uncertain about how they're going to. Now, so therefore, a 1st April start, which requires that the bills get passed by November, so that the states and the centre know what to put in the budgets, is a very aggressive deadline, right? If instead, say, it was 1st July or even 1st September, and so then perhaps there is more room for some of these niggles to get ironed out.
But for FY18, your estimates are not capturing in a GST upside. Whereas if GST implementation gets delayed, sentimentally it may push us back a bit, but not that anybody is expecting any gung-ho earning numbers because of GST in FY18.
I don't think anyone has any numbers on GST, and it is possible to have any numbers on GST, right? See, the challenge in GST is that it is such a transformational change that it is very hard to estimate the impact. And there will be a near-term impact which is actually quite perhaps disruptive, and there is a medium-term impact which is actually quite positive, right? So to start saying that I will assume that the medium-term impact is going to be very positive, and therefore I will build it in the first year itself, is inappropriate. So no analyst, I think, has done that. The one assumption that a lot of people have been making, that tax rates will fall, right? That the indirect tax rates for certain categories, which is like 26, 29%, will become 18% because that's the standard rate. I think that assumption, if someone has made, they may be disappointed. Because my sense is that, and this was there in the papers, that if they put at 8, 10, 18, 26, which means that the items that are currently facing a high rate of sales tax and a high rate of excise duty and therefore are currently seeing an incidence of 26-29%, they most likely will then get mapped to 26%. And therefore nothing changes for them, which perhaps is the reason why they are attempting something like this, if they do this. But so if someone has built in those kind of changes, then yes. But I suspect that at least in the FY18 forecast that we see right now, I don't think there is any GST built in. So even if it gets delayed by 3-4 months, 6 months, I don't think.
Okay. Now GST is next year's story, next calendar year story. This calendar year we have earnings season, which is the Q3 earnings season. It will start in next 15 days. Markets so far have been disappointed with the earnings recovery, and I'm getting a sense that the expectations with each quarter, they are not going up, but they are going down. Markets are going up and earning expectations are going down. Why is that happening, and what should we expect from this earnings season?
Let me first give you my interpretation of how I look at earnings, right? So there is this obsession that earnings are getting cut. What matters for the market is how fast they're getting cut and from what base they're getting cut, right? Because if you go through 1 year and the 1 year forward earnings estimate is 15% higher, whether it fell from 25 and there was, you say, oh, there was 10% earnings cut, it grew 15%, so the market is 15% cheaper, right? So the pace of cuts and the starting point of that both matter a lot. I think what has happened in the past 15 months, or let's say the 15 months before the past 3 months, was that the pace of cuts was very strong. So every 3 months you would see a 5, 6, 7, 8% kind of cut, because commodity prices were being cut and a lot of people and banks were taking write-downs and a lot of those things. As a result of that, the 1 year forward earnings was not moving. So as you were rolling through every 3 months, the roll forward impact was getting negated by the cuts. What has happened in the last 3 months is that the pace of cuts is now less than 1%.
Yeah.
And therefore, as you've gone through the last 3 months, and the market has been broadly flattish, when first went down and then went up, the P multiple has actually come down because now it is pricing in 3 more months of the next year. What happens in the second quarter, the second financial quarter and the third calendar quarter, as you mentioned, I fear that this quarter's earnings would actually disappoint the market. It is quite possible that, at least on the bank side, which are a very large part of the index, you could see much greater recognition of problems.
Even more.
You could see that because none of these problems are getting resolved.
But most of the banks have been claiming that, look, we've cleaned up our books as per the RBI guidelines. All the AQR challenges are history now. Let's look at the new credit cycle. Let's not talk about past.
Correct. See, I think the banks and any management, it is very important to when you talk to bank management or any management, company management, look, they're running large companies. They have to be positive. They have to motivate, hundreds of thousands of people, right? So I'm not surprised that they want to put the bad things behind and look forward to a bright future. It is our job as analysts to look at what is realistic, right? And I'm not saying they're lying. What we are saying is that there is a lot of network effect in bank NPA recognition as well. So if you saw some of the banks which had said that, December quarter we had done the worst, and then March quarter we saw a big write-down, June quarter we saw another write-down. And it was actually bigger than what even the AQR had suggested. So as other banks start writing down their assets or declaring something as NPA, the banks that have also lent to that asset but were earlier thinking that this company looks okay are then forced to recognize them as well. And I think those kind of, plus provisioning. So you can declare an asset as NPA, but how much have you provisioned against it? Have you provisioned 20%, 30%, 40%, 50%, 80%? And so we fear that those risks can actually come up.
You think the watch list, what some of the banks have declared, the damage can actually go beyond that?
I don't think, for the private banks, I think the watch lists are quite, right there, but maybe the provisioning against those can perhaps increase. For the PSU banks, it is possible, given that yields have fallen, that they could book some gains on bond sales, but my sense is that the problems on the NPA side, I think, will persist. On the discretionary side, on the staple side, actually, our consumer analyst put out his preview note. The volume growth that we're going to see this year or this quarter is going to be perhaps the worst in the last 3 years.
Why is that?
Okay. My interpretation of that, and this is the reason why I have also been saying that food inflation will fall and that wage growth will be low and construction companies will benefit, is that I think the bottom of the pyramid is really struggling. And to give you perspective on this and take a step back, see, the world is battling a problem of robots taking away manufacturing jobs. And I think, there are fund managers and analysts who are struggling to save their jobs from algorithms taking away their jobs, right? And we seem to be at the other end of the spectrum, almost a medieval problem, wherein 48% of our workforce grows food for us, right?
Very large number.
It's a very large number. It's 230 million people, right? And while the percentage of workers in agriculture has been falling, the number of people in agriculture has not fallen. So you can imagine that as productivity in agriculture improves, and it has to, right? Because as farmers get access to phones, better roads, electricity, decent law and order, more awareness, educated sons and daughters, their productivity is starting to go up. Now, the problem is that food demand does not grow that fast. I mean, it cannot grow beyond a certain point. I mean, the incidence of abject hunger has fallen. I think the last time I was here, we discussed that per capita calorie demand is falling. Population growth has slowed to 1%. So food, so if you produce a lot more food, what are you going to do with it? The global market for food is no longer as strong. And therefore, you are going to hit big surpluses. How farmers respond to that is by cutting cost. And by cutting off cost means they will automate, they will use weedicide, pesticide instead of getting people to cut it. They will use fodder crops, they will use milking machines instead of getting labor to milk their cows and buffaloes. So agriculture starts shedding people. So one is that you have surplus food. Food inflation has been the bane of our problem, inflation problem. And I think by the time the rabi crops hit the market, by say April next year, you could see food inflation coming off sharply, and the headline inflation numbers could actually be sub 4.
I think Dr. Patel is also referring to that aspect. I mean,
so in the Monetary Policy Committee, I was very, very heartening to see, and we've been saying this since May. The comment says that the decline in food inflation is not because of low base effects, that it is a change in momentum.
It's a structural change.
Yes, and I think that rise in productivity, while it is great for the listed part of the economy and the list and our markets, because then you see that housing demand starts to improve as mortgage rates come down. A lot of discretionary demand starts to go up. You see banks start to feel better. But on the other hand, the bottom third of the economy, so the 48% are working in agriculture. Some of them are large landowners and perhaps they're better off and so on and so forth. But the bottom third, a large number of them who don't own land as well, what do they do? Right? So it becomes a policy issue, it becomes a political issue. The government is, I think, very aware of the problem. It is very hard to find solutions to this problem. The solutions, even if they're implemented, will take multiple years for tens of millions of jobs to get created. And in the interim, we actually have very low real wage growth at the bottom of the pyramid. And that is the reason why low-end washing powder is not selling. That is why cream sachets are not selling. That is why large consumer companies are having problem in the general trade channel, the channel that goes through wholesalers.
So urban consumption will grow, rural consumption will not grow.
See, the urban and rural differentiation, and I keep insisting that it is not about urban and rural, it is about agri and non-agri. So rural, the non-agri part is actually doing very well because they are seeing
non-agri part is doing well, yes.
Because they are seeing unprecedented improvement in infrastructure available to them. So they're getting electricity, they're getting roads, they're getting better law and order, better facilities from the government. And I think, so it is about the agricultural part, and which is another reason why you are seeing weak cement demand growth. Because, see, housing, 48% of the households who have seen weak income growth because they're in agriculture. And this year everyone is hoping that good volume growth will mean good income growth, but as we fear, prices could actually fall or may not go up that much. So for those 48% of the people, there is not enough money to invest in new houses, new rooms, new floors, right? Which means that 48% of the households are not going to add to the demand for cement, and rural housing is 45-50% of India's cement demand, right? Which is why you would see single-digit cement demand growth, which is very worrying. What is also interesting is that almost 60% of construction jobs in India are in rural house construction,
which may not grow.
Which is not growing, and that creates another problem because the easiest way for or the easiest replacement of job for a farm laborer is a construction site. But even that is not growing. And this creates actually big problems. But for the listed space, so if you are playing interest rate sensitives, if you're playing construction companies for which labor costs and interest costs are 40 to 50% of their cost base, this is a great situation.
So you're making a case that the market leadership or the market cycle is changing. For the better part of last 5 years, it's been about buying consumer names, quality names, down the pyramid names. Now it's time to buy cyclicals, industrials, and maybe it's time to move away from quality.
Yes, not carte blanche, meaning the private sector investment cycle, I think, is still not turning. So we are not buying cap goods, So, but yes, we had gone underweight in IT in April. We've gone in a deeper underweight now. We have cut pharma weights. So we've been positive pharma for the longest time. In pharma, I see a repeat of what happened 10 years back happening in the US market. US market is the biggest market for outside India for the Indian companies. There, consolidation is happening on the customer side. So pharmacy benefit managers, pharmacies, wholesalers, they're all combining even more. A lot of consolidation happened a decade back. There's a second round happening now. Insurance companies are consolidating. And there is fragmentation happening on the supplier side. So the whole new wave of pharma companies are getting approvals and hitting the US market. So the price declines on the generic side is actually, which used to be 1-2% a quarter for a long time, perhaps can go to 4, 5, 6, 7% a quarter.
And I think it's turning on your face after the Million case. I mean, whatever sound bites we're getting up from US economy, they want pharma prices to come down.
That's more on the branded side, but on the generic side as well, because of market forces. The regulatory call is much tougher one to take, right? But I think from a market perspective, so therefore we've cut our pharma weights as well. For the first time in my role as a strategist, we don't have an overweight on staples because they're going to be the worst affected of those. We also think that two-wheelers, the buyer of two-wheeler is still not the bottom 35%, but still at the margin, I think they could be underperforming their growth. But we like everything that the top 30%, 40% are exposed to. So we like cars, we like NBFCs, selected. I mean, there are some which have actually gone extreme and we downgraded them, but home finance, we like, as I said, the first time ever as a strategist, I have an overweight on construction. We have upgraded weights on private sector banks. So we have a positive weight on metals. I mean, the lower interest cost is going to help them, and this marginal strength or the uptick that we have seen, or stabilization we have seen in China, is very good for metal prices. We've seen what zinc has done. The levels are.
Coal prices have gone up. We've seen a lot of categories where prices have gone up.
Correct. So there seems to be supply discipline and a pressure for supply discipline happening in China as well. We have seen India become a net exporter of steel. 1 year back, there was protection barriers being put around India, which are still there. But once you become a net exporter, it means that those barriers are actually quite useless.
So the heydays the springtime for steel has started.
Yes. How long it lasts is the question. So when we upgraded steel to buy about 6 months back, we said it's a 12-18 month call, right? And so we'll see. So right now, the signs that we see, like coking coal shooting up to $180, $200, or iron ore prices starting to go up, these are all signs of a very classic steel restocking cycle, right? And this is not restocking like some wholesaler is building inventory. It is everyone who had been shedding inventory that steel prices have nowhere to go but down are now suddenly saying, oh no, maybe I need some more inventory to keep my supply chain intact. And so all of those factors are what made us more positive on the metal side as well. So yes, so our portfolio looks surprisingly different from what it was at this time last year. And I think that at least on the metal side, maybe it'll last another 9-12 months at least, but let's see how it plays. But on housing finance, on construction, on private sector banks, on car makers, on some appliance makers, household appliance makers, I think that we are multi-year growth ahead.
Every side has two stories, every coin has two sides. I always believe in the bright side. So I'll take the good part first and really appreciate your time. Thank you for joining us.
Thank you for having me.
That's it on this edition of Market Makers. Thank you for joining us and thank you for tuning in.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.